Hello, we are back together again. This time we're going to talk about long-term liabilities, bonds in particular. Please note this chapter is not hard at all. It is important for you to go through this chapter very, very thoroughly because there are a number of calculations that require much more careful attention. But let's jump into it. We're going to talk about bonds and interest, and we're going to talk about how to record interest and amortize a discount or premium using the straight line method. We're going to talk about how to describe them and show them on the financial statements. We're going to talk about how leverage is discussed and what is truly leverage is the appropriate balance of equity and debt in an organization's financial statements. It gives them a levered or more balanced presentation. And we're going to also look at how these transactions appear on the financial statements, as we have with other types of transactions. But first of all, let's talk about what a bond is. A bond is a legal document where a bondholder basically has rights to expect money from someone who wants to raise cash. Organizations and or municipalities want to raise cash, and they do it through a bond offering. Bond offerings can be munis, or it could be serial bonds, it could be corporate bonds, but the bottom line is there are these transactions that allow institutions to borrow a tremendous amount of money without having to give up ownership, in this case, stock, equities. So that's what a bond is. And specifically, everything that I would say for you and me as individuals, when we purchase debt, when we purchase items, assets, and they're long-term in nature, almost always they're bonds. Bonds are sold on the marketplace. They are a security. And for many who actually issue bonds for you and me to purchase cars and homes, etc., they are a source of income for them. They use it primarily to earn revenues. How do they do that? They do it through the cost of that bond, and that's called the interest. So bonds are attached to a security, which is a legal document which obligates the bondholder to pay back monies in the form of interest and principal, depending on the lifespan and the bond indenture. So a debt is simple as that. It has to be paid back. It looks a lot like a stock certificate, but it really isn't. It is a certificate that tells you the company's name that's actually you're lending money to, the principal or the face amount of the bond, the par value. And we're going to talk about all these terms. The date that it matures, meaning you have to pay back the principal, the rate of interest that it will pay, and the timing. Many bonds are semi-annual, meaning 2 times a year you'll get interest payments. Some are more than that, but for the most part, we're going to do the 2 times a year interest rule because more bonds follow that rule than not. Bonds have a number of different type of attributes. They're term bonds, which they are fixed in terms 3, 5, 10, 30, 40, that sort of thing. There are serial bonds, which I mentioned several times in previous discussions, particularly when we talked about current liabilities. Serial bonds can have maturity dates that involve over time and could very well be short term, which means you'll have to make certain part of that debt is a current liability. Some of them can be secured. Now, when I talk about bonds, like a mortgage bond or a finance vehicle bond, those bonds are secured by the asset itself. A house, a building, a car, those are secured, which means that you hold that bond and you have to pay it back. But at the same time, if that person defaults on paying you, then they have to relinquish the assets attached to it. Unsecured bonds are just based on the good faith, AAA status, or good credit rating of that organization. A corporate bond, same thing. Many of corporate bonds are unsecured debts, but their rate of interest is pretty high because they're risky. Nevertheless, knowing the terms, the types of bonds is kind of important, particularly when you're trying to understand why they're presented in a certain way, and that's going to be important as well. Bond prices. The bond prices is quoted at the percentage of their maturity value. For example, you have a $100,000 bond, and it's issued at 0.99. Well, guess what? That 0.99 is significant. So although that bond is $100,000 that you have to pay back in 3 years, 5 years, 10 years, or 90 years, you only get 0.99 of that bond. So you just take the 0.99 multiplied by 100,000. That's going to be the amount of bond or cash that that organization or individual receives. So if a bond is issued above that 100,000, it is called a bond issued at a premium. If the bond is issued at 0.99, which is going to be below the 100,000, it's going to be at a discount. So what we want to talk about here is what are the things that I think is most difficult for students when it comes to bonds is calculating accurately the interest expense and calculating accurately, depending on whether you straight line or interest method, the effective interest method, calculating the amortization associated with either a bond, premium, or a discount. That gets a little complicated because there's so many different rules. So I would like to take this time in this lecture just to talk about it in general and follow up in another video to go over a specific type of transaction and how I can demonstrate how you can create these entries and calculate accurately the amortization, the interest expense, and then ultimately the journal entry. But for purposes of reading through the chapter, knowing very well that if a bond is issued, the time is issued at an amount that's higher than the face amount of that bond, and the face amount is the amount that you pay back, that's at a premium. If you issue that bond at a price lower than the face amount or the maturity value of that bond, it is at a discount, and that discount amount has to be amortized over the life of that bond, i.e. be in 3 years, 5 years, 10 years, 30 years. It has to be amortized, and the amortization of that bond, premium or discount, will vary depending on if it's straight line used or an effective interest method used. We talk about time value of money because we want to be able to say if we're given a scenario and we want to determine what that bond cost at the time of issuance, it's important to know the time value. And that's important as well because you want to know the value of the bond interest. And we know that we are paying an X amount of money for interest. But if we want to take that dollar amount and move it forward, what would be the value of that dollar 5 years down the road? That's the time value of that money. Or we want to know this is what we have to pay in the future. How do we discount it back to the present? So the present value and the future value tables are kind of important because we're taking these numbers and we're trying to either discount them forward in time or take them and put them back in the present. So we want to go from future value to the present value. And in case of that, that would be your principal. If you're going to be paying back $100,000, how much is that $100,000 worth today? So you want to take a future value and convert it to a present value. And in case of interest, you want to take the present value of that interest payment and move it to the future and with that value. So you want to know the future value of the present value amount. So you're going from present value to future value. And that's what always creates the challenge for students. So I think a demonstration would be the best way to do it. So the interest rate is going to determine the bond price. And there's a stated rate and there's a market rate. The stated rate is going to be what's on that coupon, on that bondholder document. And you'll see it clearly evident. The rate of interest market-wise is just what's the going rate, the CPI, what's going to be the going rate. So, and here we are just giving you an example. One of the things that you'll need to know is there are 3 things, I think, that are critical calculations. And there might be more, but these are the fundamental ones. 1, how do we determine the issue price of a bond? How do we determine the discount or amortization of that bond? Using either the effective interest method or the straight line method. And number 3, how do we calculate or prepare the journal entry recording the cost or at issuance and the semi-annual interest payments. And so when we think about this chapter, those 4 concepts are going to be prevalent and they're going to be the very, very important ones that you have to master. So step by step, how do we determine what the price of the bond at the time it was issued? How do we amortize the discount premium using both methods? And how do we record the journal entries associated with the cost of that premium of that bond and the semi-annual payments that are made of interest? And that's going to be I would say, the fundamental principles that you must gather from this chapter, and you must review the examples to do so. So in this case, the stated rate on the bond is 9%. If that stated rate is the same as the market rate, the bond is issued at par or at face. And par means the maturity value. The face means the maturity value, because when you look at a bond on its face, it says 100,000. That's par. And so all these words that I just used mean the exact same thing. So if the stated rate or the coupon rate is the same as the market rate, we know the bond is issued at par. But if the stated rate is at 9% and the market rate is at 10%, we know that we're going to have to offer a discount. We're going to have to expect less for that bond. We're going to have to expect less money because the market is paying a higher rate than what we are paying. You get me? So if the stated rate is lower than the market, discount is always the case. And you don't even have to do any calculations to determine that. All you have to do is look at the two rates, and when they're different, which one's higher is going to determine if it's a premium or a discount. So if the stated rate is going to be lower than the market, we got a discount. If the stated rate is higher, in this case 9% interest, stated rate, and market rate is 8%. Oh, we're paying more interest than the market is paying. That means people will be willing to pay more to you for that bond. Think about it in those terms. This is a very extremely important illustration that you should remember, because it's not something that's going to come intuitively. So I would highly recommend taking that one page of your chapter and putting a little sticky on it, because you're going to always refer back to it. When you look at a transaction that's presented before you, you'll know off the bat whether or not it's going to be a premium or a discount, because you have this cheat sheet in front of you. So here's a standard entry. Again, when you're going to borrow money, you're going to issue a bond. You are a bond holder. I hold a bond. Southwest holds a 9%, $100,000 bond that's going to mature in 5 years. One, we already know is long term. Two, we already know is at par, right? And then we're going to actually record the entry, because we are looking to raise money through a source outside of equity. We know that off the bat, our first account is going to be cash, because we are getting cash. We are raising money. And two, we want to know that the bond is issued at face. Well, guess what? We're going to report them at 100,000. How do we know it's issued at face? Because it told us issued these bonds at par on the first of the year 2018. Whenever you hear the words par or face, you know for a fact that there's no discount and there's no premium involved. So you're going to debit your cash and you're going to credit your long-term liability. Simple as that. Now, when we have to record the interest, again, standard bonds are going to be paid in interest 2 times out of the year. How do we do it? Standard issue. We're going to take the coupon rate and we're going to multiply times the amount of the bond itself, and we're going to prorate it for the time. In this case, 1/2 of the year. 6/12 is equal to 1/2. And here is our entry. Straightforward when you're talking about that. It gets a little bit more complicated when we deal with entries in between interest dates, when we have entries that are above par or below par. It gets complicated, but that's right now very basic. Going forward, when the bond is paid back, however, we're going to remove the bond from our books at face amount, 100,000, and reduce our cash. Straightforward entries. Now, what if we have a bond at a discount? And how do we know it's a discount? Because the difference in the coupon rate of 9% is lower than the market rate. So the market price of the bond is $96.50. It's $96,150 at issuance. So we know the cash was given. So we know that if we have a $100,000 bond and we only receive 96, we have to assume there's a discount involved. And we also have more evidence to show, because we're given the interest rate and the coupon rate. The coupon rate is the 9%. The market rate of interest is the 10%. And when the stated rate or the coupon rate is lower than the market, we have a discount. So here is the entry. And again, the bond discount is going to be a debit. going to be the completely opposite when you're talking about a premium. Let's just deal with the discount side of things. And here it looks on the balance sheet. And again, we're using straight line, nothing majorly complicated when it comes down to recording the interest. Now, when we talk about handling the bond discount and amortizing that, again, we have a bond discount here of $4,500. Well, let me get you back to the discount. We got a discount of $3,850, and we have a bond here that is 5 years. So that $3,850 has to be divided by 5 because we're using straight line. So we take that $3,850 and divide by 5, we get, divide by 10. Let me explain the 10. Whenever there is a 2-payment type of situation, 2 times out of the year, there are not 5 payments, there are 10 payments. Because you're going to be multiplying the payments of the 2 times it's being paid, the 2, times the number of years, in this case 5 years. So we have 10 series of payments being made, which is why in this case it's semi-annual, which is why when we amortize the $3,850, we're going to divide it by 10 as opposed to dividing it by 5. Either way, the most important thing to note is when we record these transactions, we have to record the interest and we have to reduce the discount. So in this case, we see the interest calculation is going to be exactly the same. 6/12 out of the year times 9% times 100,000. The only thing that's different, however, is we have to now include the amortization of that discount. And here we're taking the $3,850, which is the discount amount, divided by the number of periods. In this case, 10 periods over 5 years. That gives us $385. We're going to take these two and we add them together to come up with our interest expense. This is a very important concept. When there's a discount or the amortization of a premium, it's going to change the interest expense that we record. So let's take a look at how it looks in the journal entry. The interest expense is $4,885 because obviously it's the 2 amounts added together, the $4,500 plus the $385. We're going to reduce our discount because eventually the discount is going to be netted to 0 at the end of the 5-year period. And then we have to pay out cash. So the amount of cash we pay out does not change at all. So one part of the interest you already know. Just multiply the coupon rate times the discount, times the bond times the time. So what you see here is what makes it different is that we have to now consider amortizing the discount. And because a discount has a debit balance, every single time we amortize and we remove part of that discount, we have to credit it because we're going to have to reduce it down to 0. So that at the end of the day, that the book value of that bond will ultimately equal the face amount as we continue to amortize the discount. And here is an example of a bond issued at premium. Now think about it like this. If we're not given, look at this, we're not given an interest rate. You see here, there's no interest rate given, but it's given an amount that's over 100%. So that should tell you right off the bat. That's another clue. The bonds were issued at a price of $103.85. And if you take that, you say, okay, if I multiply that, I think I know what's happening here. We are getting more than the face amount from our bonds, which is good. So now we have to consider, we're going to get $100,000. No question about it. But how do we deal with the premium associated with this bond? All right. It's going to be the same thing, really. You're going to be paying $4,500 every 6 months. But then the difference of the $3,850, which is $3,850, because it's higher than the face amount, that $3,850 has to be amortized. And we already know straight line because we're going to divide it by the number of periods. 10 periods, $385 each period, twice a year. But the difference then becomes, the interest expense then becomes a higher number. So let's take a look at how we calculated that. Let's see. I want to see if we had a detail of that. It didn't show it. Well, what happens here then is we're going to take $4,115 Why is that? Because we're taking and we're adding the $385 to the interest expense. I'm going to show an example of this in a prior tutorial, because this one here, the way it's shown in your textbook, is not necessarily the easiest to follow. So just bear with me on this. Just remember, when you're reading this, whenever there is a premium on a bond, it's going to be decreasing the premium, and the premium on the books is going to show as a credit. And I don't know why in this illustration we don't see the journal entry to show the issuance of this bond at the premium and how it looks in the journal entry form, which I don't particularly think is the good idea. I think it's a bad idea. Now, we gone over creating these transactions using straight line. The effective interest method, which is most commonly used, is going to be considering the time value of money. And every single time period, we're going to deal with a different interest expense, but we're going to be able to determine how to work these calculations once we build an amortization schedule. And it makes it a lot easier to see with an amortization schedule. The effective interest method is using this type of time value of money, and it more accurately presents the financial information, particularly as relates to the bond amortization and the interest expense on the balance sheet, far more accurately than the straight line method, although the straight line method is far easier. But if you could take a look at this, you can see how we can calculate the interest expense using the effective interest method, and it changes. Why? Because the carrying value of that bond changes. And as the carrying value of that bond changes, so does the interest expense. And because we're going to take the interest expense and subtract it from the, I would say, the basic computation of the interest that's going to be paid to the bondholders, the $4,500, that $300 is going to be the amortization. And in this case, the amortization will go down steadily until it reaches zero. And as you can see, the carrying value of the bond gets higher and higher until it reaches $100,000. The effective interest method in this column C is going to be really, really important, because you're absolutely calculating a different figure for interest expense based on the carrying value of the bond. Versus here, you're using the base amount of the bond multiplied by the interest rate. And again, this is calculating based on a 2-time-a-year interest payment. As you can see, instead of it being 9% stated, it's 4.5%. Why? Because the periods are 20 versus 5. I'm sorry, the periods are, let's see how many years we have here. We have a 9% and we have a 5-year period. So we have 10 periods here versus having 5 periods, because it's it's 2 times out of the year. So the number of periods is going to be the number of years multiply how many times that payment is made. In this case, 2 times. So 5 years making 2 payments gives us 10 periods. In this case, we're seeing 10 periods. So I think the key to using the effective method correctly is always being aware of the carrying value of the bond, which is why an amortization schedule is very, very helpful, because you can actually see every single time as the carrying value changes. At the time of the issuance, you see it 96, but it gets bigger and bigger, and then the calculation of interest changes as such. And the only thing that we are really looking at here is the discount amortization is only the difference between these two columns. So it really makes it far, far easier to understand how to amortize the discount or premium and how to determine the interest expense, because the amortization schedule truly uses the carrying value in its computation versus what we paid in cash, because this is the amount we pay in cash to. I mean, this is where we're legally required to pay 2 times a year, 9% annually to our bondholders, which is equivalent of 4.5%. That's the legal requirement. But the interest expense, however, that we calculate is going to be not based on a flat 100,000. It's going to be based on the carrying value, which is going to proportionally go up. And as you can see here, you're going to see the interest expense get bigger, bigger, bigger as time goes on. But at the end of the day, we're using the carrying value to compute the interest. And any difference between these two will be the amortization that's appropriate. And that's what makes this, I believe, this particular part of this chapter much more difficult for students. But I believe using this amortization schedule and seeing the relationship between how the interest expense is calculated and how the bond carrying value triggers that calculation is far easier to compute it. And we are essentially using the contract, we're essentially using the present value in our computations inherently. And again, if you want to think about it, this is the amount that we pay in cash, and it's fixed by contract. And this is the amount that we are going to be expensed based on the carrying value of the bond. And any difference between the two is going to be what we amortize. And here is just giving you some of the relationships. And I would say, to me, the most important thing, however, is really understanding how the interest expense is calculated and what relationship it has to the carrying value as that particular asset, or in this case, liability, is proceeds through time. And it's giving you another example. And again, straight line, here is the interest. Same amount every single 2 times a year. But amortization gets bigger and bigger and bigger if we're using the effective interest method. But on a straight line method, it's going to be absolutely the same. It's going to be a fixed amount over the life of that bond. And as you can tell, the bond started off at 96 in terms of its carrying value, and carrying value gets bigger and bigger and bigger until it reaches maturity, and the bond carrying value and the face amount ultimately at the end of the 5 years equal. And here are some entries to show at a discount. I want to see at a, now that's perfect. Now this is what I wanted to see. If the bonds is issued at $104,000, here is a premium. But then look at how the entry looks on the balance sheet. With the discount, it was a negative number, and giving you a negative, I'll give you a lower than a face amount. You can see the two numbers here. But then as it gets amortized, however, the number gets smaller and smaller and smaller and smaller. And the effective interest method works exactly the same. The only difference is, instead of the carrying value getting bigger, the carrying value gets smaller in the case of a premium, until ultimately it equals the face amount or the coupon amount of that bond. Same principle applies. It's exactly the same. You're going to be using the carrying value and multiplying that times the interest rate and taking the difference between that number, and that will be your amortization of your premium. This chapter is an extremely important chapter, but I think in some ways it can be extremely complicated because there are two different perspectives that have very different manners of presentation on the financial statements, and it could be kind of complicated. My advice would be to take the straight line, understand it fully, how straight line is used, what it looks like, not only on the discount side, but also on the premium side. And then take and reverse it using the same example and using the effective interest method. I would say the amortization schedule is very, very helpful, and it actually provides a very good visual of how it looks and how easy it is to calculate the interest expense, and how it compares to the contractual amount of interest to be paid to the bondholders, and how you can see how that amortization of the discount or premium is in fact calculated. So, accounting for other features of bonds, partial periods, or you buy a bond midway into the process and you have to deal with partial interest and all of that. It's just more complicated than it needs to be. What you need to understand is how do we time and how do we affect our entries based on a prorated interest. Do we get the interest in advance? Do we have to pay more to account for that interest? And how it looks on the financial statements. And these are far rare events. The more likely you're going to see the one issued at the beginning of a quarter or beginning of a year versus midway. And everybody knows it's far easier to follow, far easier to track, and it's just, I would say, far better transaction to be involved in. And most organizations don't purchase their bonds mid-year. They definitely don't do that. It's definitely something that's timed very well. And because a bond is a very, very significant and very serious contemplation requiring attorneys and other investment in SEC as well, and banks, chances are they'll know 6 months to a year in advance whether or not this particular bond is going to be going to happen, and all the legal involved transactions. So I don't foresee this being something that is going to be carrying forward in the future. I think you'll most certainly more likely see bonds being issued either in January or July and not in between. But there are other things that we need to be concerned about. Sometimes bonds can be retired early, and it has to be specified within their contract indenture that they can be called back and they could be converted to equity. I mean, again, these conversion features and these options have to be laid out in the indenture, because an indenture is a legal contract. This is a very, very serious transaction, and if these bonds can be called for maturity, you need to be aware of it, and it's included in the contract. And the same is true if the bond is being called or a bond is convertible to equity. You have to know that. And if it's a convertible bond, it's going to cost you more, because you have that option as a bondholder. You have an option to convert it to some equity if you wanted to. But again, it's in the contract. And here we're just going to go over just understanding how to deal with these type of transactions. And it's very similar to an asset that you would have and you decide, I purchased equipment, but I'm going to sell it before I've actually fully depreciated that. How do you count for the loss or gain? That's all it is. You think the same mindset. If you're going to get rid of your asset before you fully depreciate it, you have to recognize a gain or loss in that transaction. You have to deal with the cash received and the book value and what the market price is, and all of that. It's the same principle, nothing very new in this. So convertible bonds, which I've already mentioned, again, these bonds can be converted into stock. And again, it's a big, big deal. When you have a bond that you convert to equity, you know you're going to have to pay more for it. And those transactions are more complex and have to be most certainly disclosed on the financial statements. You have to say, I'm going to have a convertible note payable. You have to disclose that. And on the equity side, you have to show as if that organization converts it. When you have to deal with recording diluted earnings per share, you have to show that what if these people did in fact convert it when they didn't, and you have to show what would be the effect on earnings per share. And again, this is all complicated intermediate accounting stuff, but again, it's something that you need to be told that these transactions are much more complex and can very well have extensive disclosures in financial information. So other long-term liabilities include I would say having accounting records that reflect GAAP versus having accounting records that reflect tax. And again, there are only a few transactions that are very, very different between tax and book. Most of it has to do with straight line depreciation using makers or modified accelerated depreciation, or it could very well be other types of transactions. But in the end, if these differences are not reflected on the books, a lot of organizations set up a different set of books and show all of their tax implications and combine the differences that exist with GAAP principles. And that includes the direct write-off method, which is not allowed for GAAP, the allowance method, which is not allowed for tax, straight line, which is not allowed for tax and allowed for GAAP, makers, which is permissible in GAAP but is required for IRS. These are the book tax differences that sometimes create tax savings or additional tax liabilities. And that's basically what we're talking about in this section here. What are these transactions, how they're accounted for, and what effect it has on long-term liabilities. And in the disclosure, if you have a commitment to pay or to provide a service, you have to describe in your financial statements all of those kind of commitments, your promises, your obligations, and some significant details relating to leases and all of those agreements. When it comes to liabilities, I would say companies are more likely to provide an extensive amount of information, particularly on bonds, the indentures, how long they're being placed, whether they're corporate bonds, whether they're serial bonds, whether these bonds are callable or convertible. All of those details have to be outlined. Coupon rate, market rate, all of those information have to be disclosed for purposes of providing useful information to users. How does having a liability affect your ratios? Well, we have a debt ratio, leverage ratio, and again, we're going to talk about this in chapter 12, I believe, and how we use ratios. My advice with you in these chapters up to 12 is understand what the ratio is and what it is, and what that ratio is intended to provide the user. We're going to put it all together in one particular assignment, but for now, the debt ratio is going to show how well this organization meets its obligations, but it will also show if this organization is in trouble. Are they overwhelmed in debt? And how do they compare to their peers? And then also, how does their average assets, I would say, how does their average assets work to provide or increase their equity? It's just going to show how much of each dollar represents equity in their assets. And that's incredibly important, because if you're looking to invest in an organization, you truly want to be able to get a sufficient return on your equity, whether it be through dividends or whether it be through asset appreciation. So having an appropriate leverage is going to be important. It's actually a very urgent ratio when you're looking at an organization overall. And here are this interest earned, and this one here only applies when an organization has some kind of debt. So if an organization has no debt, then you can't possibly calculate the times interest earned. But it does measure the number of times the operating income can cover the interest, and that's important. I mean, when you look at these organizations, when they're overwhelmed with debt, their times interest ratio may very well be low. But if it's high, that means that they not only have good operating revenues to cover it, but they're pretty well under the debt, undercapitalized in debt, which is very positive for organizations. So how do we look at our long-term debt? Let's just take a look at that, and then I'm going to close. And again, we're looking at our current liabilities shown here, but then we're going to show our long-term liabilities. And again, how do we show this information on our financial statements is to make certain that people are clear what's long-term, what's short-term, and having those items reported in order of their maturity is absolutely critical. We want not to mislead users of our financial information. We want to be clear and transparent as to what our obligations are to others, third parties. But we also want to make certain that that the information, not only in the face of our statements, are clear, but our disclosures are appropriate. Rates are disclosed, and all of that. So financial information goes beyond just the financial statements, but also the notes which explain the numbers that are contained in those financial statements. And here is an adapted portion of the statement of cash flows, which we will talk about in chapter 11, I believe. So just see that all of these chapters are actually working together to give you a full picture of how to report and to show financial information and interpret it for users. I really appreciate your time in this particular video. I know it's long, and I will follow up with a tutorial on how to record the bonds transactions using both the effective interest method and the straight line method. Thank you very much.